Corey, how you doing, brother?
Good, Gary. Thank you very much. Thanks for the invitation.
Yeah, listen, I'm excited to do this. I didn't hear much about you up until last year. And like everywhere I turned on Facebook and Instagram, Corey, Corey, Corey. I'm like, who is this Corey guy? And I'm like, I gotta have this Corey guy on my show. So I'm glad you're here. Good to see you. And you're doing some great things.
Yeah, thanks for putting a positive spin on that. I mean, a lot of people got overwhelmed, but you put it in a very polite way. So thank you for that. Yes, it's been a very busy year. So looking forward to being on your show to talk to your guests.
Yeah, no, but you've been doing some great things. I know you did that huge summit there with Elizabeth Kelly. I didn't get a chance to sit in on all the events, but the couple that I was able to kind of see, it was like, wow, really great content, great questions, great answers. It just looked like a real fun and well organized. I'll say that as well too, well organized event. So kudos to you in putting that on and pulling it off.
Yeah, we actually spent 6 months on that. I kind of did a mini summit back in March of 22 where I had Elizabeth as a guest. And we decided to take on something more aggressive because, as you know, the real estate market changed dramatically from March of 2022 to the end of 2022. So we really felt compelled to do another updated summit, but we wanted to go, full bore. We got a special platform, that was like navigating the space shuttle, right? It was a very good interactions. We had all kinds of polls and chats and live stuff, a gamification. Contestants could compete with each other, and we spent about 6 months planning it and putting it together. But it was well worth it. I had a blast doing it, and thanks for the compliments. We're actually doing another one this October that maybe we'll talk about towards the end of the broadcast.
Yeah, for sure. We'll definitely dive into that because I think, especially in what's happened, the aftermath of say last year, we'll call it. A lot of people have now been put in some serious situations where it's a little bit difficult for them, and I think these type of events to bring out some of the best in the industry, to ask them questions, to hear what they're doing and how they're pivoting and adapting is really important. So I think things like this are really important. So I'm glad that you're doing it. And I'll definitely dial into that one for sure. Right.
Yeah, well, you're going to because we're going to invite you to be a guest. We're going to have you have you speak on there if you say yes, but we'll have that conversation another day.
Awesome. Well, I appreciate that. Thank you very much. But listen, today is about you. I want to know more
Okay.
about your story because I don't know your full story, like how you got into it, why you got into it. So we kind of maybe just dive into that, and then we'll see where it goes.
Yeah, no, it was very interesting how I kind of got into real estate. Back in, I was a renter for a long time, when I was, first out of college, first couple jobs in the late 90s. It was a totally different economy back then. Very few people that I knew that were my age owned a home, even though houses were very cheap at the time. But I took the plunge and I bought a single family home in 2000. And, it was a house hack. Yeah, accidentally, it actually had a suite. So I ended up renting it. And then that's when the lights kind of turned on a little bit. And I ended up going to work overseas. So I was going to work for a month on, month off. And I was getting all this rental income from the house. And I thought, well, this is really cool. I mean, how can I scale this up? So my wife, she bought me a book, the dreaded purple book, Rich Dad, Poor Dad.
Right.
So 2001, it was a real hit. And I was reading it on the plane as I was heading over to Central Asia. And it's like, oh, okay, this is pretty cool. But how the heck can I do this remotely? So that was kind of how I got into JVs and, being an active participant in a JV. So that was actually how I got into multifamily. At the time, the only real mentoring programs there were RAIN, like the Real Estate Investment Network. There was really no other coaches or mentors out there, and real estate investing really wasn't, that popular in Canada the way it is today. So I reached out to RAIN. I was a member. I found a gentleman there, Thomas Byer, who was already doing multifamily. I looked at different strategies at the time, rent to own, duplexes, up down suited houses, which I'd already been familiar with, and it was a pain trying to manage that from overseas. I thought, well, hey, multifamily is great. So I invested, 25,000 with him back in 2004. And basically the rest is history. That kind of opened my eyes to multifamily. And that's what I've been doing ever since.
Wow. Okay. So your first investment property was a joint venture then?
My first multifamily. So I
Your
had a
first multi.
series of singles before that. So I obviously had my house hack. I had an up down. I ended up buying 2 or 3 more singles, and then I also had a side-by-side duplex. And that was kind of where I stopped as far as, real estate
Got it.
investing in
Okay.
single family.
Right. But then multifamily, once you got your taste in multifamily, you're like, okay, this is the way to go. And not
Yeah.
only just multifamily, but it seems like also partnering with somebody who's an expert in that area as well, too, correct?
Yeah, and at the time, I mean, I had a high-paying job and I had the money. I could have bought a multi, but I had no idea of even how to go about this. And thankfully, I went the JV route because, my mentor Thomas at the time, he was very happy to show me the ropes, especially the pitfalls. And as I learned over the years, there were many, right? I mean, you can make a mistake in single family and probably be okay, but not in multifamily. I mean, you make one error and it can be fatal, right? You're dealing with, tremendous amounts of capital, um, you know, substantial guarantees for millions of dollars in mortgages. You have like items like roof boiler systems, deferred maintenance issues that can be hundreds of thousands of dollars, foundation issues. So, and plus you need to do like environmental reports, appraisal, like there was all kinds of stuff that I just didn't understand at the time. So, going through that process with Thomas really helped me out to understand and pave the way for going forward. So I bought my first 2 apartment buildings with my own cash, and that was uh that was an experience and a half, I'll tell you that. Baptism by fire.
Really. So let's talk about that because I
Yeah.
think learning from people and investors who make mistakes is, I think, always the best way to do it because now you can avoid those landmines, right? As opposed to stepping on them yourselves. Hey, this is the landmine that I stepped on. You don't want to do the exact same thing. So what were some of the issues that you went through and how did you overcome them?
Yeah, so the most common mistake I see new investors in multifamily make, I see a lot of people that are really sophisticated singles, but they always make these same critical mistakes in multi. They look for multifamily buildings across the country. They do a very broad search, and you should focus on one key niche and build a team there, right? And that's what I didn't do on my first deal. I thought, okay, here's a building that's 400 kilometers from my home. I just started a full-time job. I had a brand new baby. This building was completely run down. It was a BRRRR, the buy, refinance, rent, renovate kind of thing. But back then we called it value add. I mean, the term BRRRR
Right.
wasn't used. So again, so I didn't go in the niche where I was living, which was Edmonton, which would have made the most sense, and hired a property management company that could manage it. I didn't do that either. So those were the 2 big mistakes. Now, the building was only 29,000 a door. I mean, it was 350,000 for 12 suites. Pretty tough to go wrong, but it was a complete gut, right? It needed roof, it needed like total suite renovation, everything. I got
And how many
a loan from
units?
the.
How many
It
units,
was
Corey?
it was 12. It was a 12
Okay.
plex,
Yep.
but yeah, but it needed a lot of work. I ended up getting a 1 year loan from the local credit union, and it was just a time, vampire, right? I was like dealing with all kinds of stuff while I was at work. I was driving a service truck in the oil patch, talking to my on-site manager at the time. I look back on that now and Gary, and I can't not believe that I did that for 2 years. But after 1 year, I wasn't done the renos. I didn't have the income to where it was supposed to be. The bank called me and said, "Hey, Cory, this 250,000 you borrowed a year ago is due. Like we want it now." And I didn't have it, right? So I was like, okay, can you give me an extension and then we'll do a refinance? And that's how I actually did the BRRRR. So, the quick numbers on that, we paid 350. I got a new mortgage at 404, and then we sold the building a year later for almost 600. So we did very well. We made a nice profit, 130% ROI in 3 years. But I would never do that again in my life, right? I mean, a few things happened that we got lucky. And I learned a little bit on my next deal in Edmonton because I actually got a property manager. But again, I made some critical mistakes when I was buying the property, and it was really a strong real estate market that kind of saved my ass on that deal. But those 2 deals really laid the foundation for my investing strategy today, which is vastly different than it was.
Yeah, and I definitely want to dive into that as well too. Now, how were you finding your deals back then? Because you've been in it obviously a
Yeah.
number of years, compared to how are you finding your deals today, or are they the same?
I've changed my scope of search a little bit. I obviously have a much larger network than I did before. I started with one realtor, which is what a lot of people do in multifamily. But the truth is, in multifamily investing, one realtor is not enough, right? Only realtor will only know a certain amount of buildings. You need to be establish relationships with multiple real estates, brokers and agents. So, the CREBs, the Avis and Youngs. You need to start making inroads with all of those companies and basically getting the listings as they come out and kind of eventually get on the short list so that you get deals funneled to you. Now, that's easier said than done when you're starting out. And, when I was starting out, I was just going online. I was going on those sites and I was contacting those realtors and making offers on a couple deals. I learned right away to make an offer through the agent who had the listing, not just through someone that you've been working with. And that's kind of what I did on the first couple deals. Now, I have done a couple of direct seller deals where I've gone directly to the seller. And this is a common misconception in multifamily. A lot of people think, well, they'll contact the one superstar realtor, right? And let's just say it's Winnipeg. I'm just going to say examples. There'll be one guy that is very well known in multifamily, right? So every single person contacts that guy. And the guy's like, well, I have like 500, people that want buildings and I have like two buildings for sale. So, it doesn't really work. That's why you need more than one source. So, but a lot of people think that seller financing, or it's not seller financing, but finding a deal direct from sellers is the preferred way to go. But the truth is, honestly, 95 to 98% of all transactions go through some kind of real estate agent or some kind of broker. So I didn't focus enough of my time there, but now that's pretty much all I focus my time on. Is just working on those relationships, putting in offers that I think are fair and reasonable. When those deals don't go through, I get the callbacks to pick up those deals later on, when the vendor becomes more reasonable.
Right.
And that's the strategy that's worked the best for me over the years.
So in the beginning, what you're really focusing on, or somebody who's brand new to this should be reaching out, building their network, and so that in turn they're now getting deals that are coming into their inbox that they can now sit down. And so when they're getting these deals coming in, what's that first step? Like, are they now starting to plug them into their performa, analyzing these deals? Like, walk us through your process of buying a multifamily for somebody who's listening and they're brand new and they're thinking about scaling up from single or 2 units or 4 units. Like, what does that process look like?
Yeah, that's a fabulous question, and I love the way that you worded that in at the beginning. And how do you approach the realtor? So I do teach other people how to do multifamily investing, and one of the things that why they're reluctant to reach out to real estate agents is because perhaps it's a cash business, right? You have to have the capital or you have to have the JV capacity to take down a deal. But you still want to learn, you still want to go out and, dip your toe in the water and see what's out there. But a lot of people are afraid to contact realtors because then they don't want to become known as tire kickers, right? Or time wasters. That's their greatest fear. And actually, I did that at the beginning. I mean, I wrote offers on deals that I didn't close, and I almost didn't recover from that. That's an aside story of a lesson that I learned very hard. But if you want to scale up from duplex to fourplex, the first thing I would suggest is just get on those lists, and you can talk to those realtors, but you can just be honest and say, look, I don't have the capital right now, but I'm raising capital, but this is what I'm looking for, and please put me on your list. And then as you see the deals and you start to see what they are listed for, what they sell for, you'll start to develop a feel for the analytical side. I've seen I've seen crazy pro formas where guys will have pages and pages of analysis, and you're going to do that to 300 buildings that are for sale. Well, no. I mean, I have a very, very quick filter mechanism, Gary, and the biggest change now is because of the lending environment, right? Rates are higher now. Lenders are capping loans. It goes by the debt coverage ratio.
Yep.
So I just simply look at the income and expenses. I look at what the market rent is, and then I determine how much money it takes me to get to those rents, and that's how I get the price. And I can do that on a building in about 5 minutes. So, on any given week, I'm probably looking at, anywhere from 15 to 20 listings. Maybe 2 of them need follow-up that fit into this formula, and then I'll dive into a deeper analysis after that. So for newbies, that's the process that you should, start start building a database of buildings. And you do that slowly over a period of a year. And then by the time you've raised the capital, you're ready to pull the trigger and get your first deal.
Right. And now what kind of performer should they be using? Because obviously a performer that you're going to use on a smaller single family 2 unit is going to be different from a 12 unit. Is there one that you recommend, or just go online and pick one?
Yeah, so that really comes down to cap rate. You'll hear this term a lot. So they basically take like, let's just say we had a 20 suiter, for example, $1,000 a month rent.
Yeah.
So let's say it's $20,000 a month. Our expenses are about 10,000, let's say. So it's like 50%. So then you determine that your income is, 10,000 a month, times that by 12, 120,000. And then divide that by the capitalization rate for the area to get a purchase price. And then if you're in the kind of in the ballpark. So cap rates in Edmonton right now are about 5.5, 6%. So that's kind of the first thing you want to look at. But the biggest thing you need to look at on a pro forma, honestly, it's very simple. I can break it down even more because I kind of talked a little fast there, is really the income and expense piece, right?
Mhm.
The income is the rents, what the rents are. You're more concerned about what the actual market rent is, especially if there's upside.
Yep.
But most importantly is the expenses, because, at least in my markets, realtors are infamous for, I won't use the word infamous. That's bad. I'll say they're famous for kind of embellishing the numbers on expenses, making them lower than what they actually are.
Right.
And the rents, they'll have a projected column. This is what the rents can go to as soon as you buy. All you have to do is give rent increases and bang, like magic, right? But it's a way that they can inflate the price for their sellers. And I do the same thing when I'm selling a building. But as an investor, you really have to know what those numbers actually are. So for expenses, it's fairly easy. Right now, we're at about $6,000 per unit per year. So I can look at a pro forma very easily and see that okay, they're at like 4,500. That's too low. Some of the more reputable firms, like Colliers, for example, their pro formas would be very accurate. They're usually in that 5,500 to 6,000 range. Unless it's a brand new building, right? Then you might have lower expenses. But quick look at the income and expenses and the capitalization rate will generally give you a good idea of how much the building is worth.
Got it. Yeah, and that's great tips and great advice as well too, right? Because sometimes just you need to simplify it, break it down, but then also too, it's also a matter of continually just running these numbers and getting familiar with it, and then that'll help you also build that confidence. And I think also too, going back to what you said earlier, sometimes it's good for your first one to do a joint venture, right? And do it with somebody who's experienced and knowledgeable and knows what they're doing. So now you've put that offer in, you've done your home inspection, you've done your environmental, right? Is there anything that when you're going through that you need to be aware of as well too? Because obviously you're going to have clauses in there, and these clauses are typically going to be a little different than your typical regular residential property, right?
Yeah, the contracts are quite a bit more complicated. It's not unusual for a deal to take 6 months to a year to close. For example, I'm on a deal right now on an 18 suiter. We're going to close on May 1st. I've had this building under contract since July of 2022. So that gives you an example of just how long it can extend. But yeah, mostly there's two sets of conditions. There's financing, which is big because it's commercial financing, and due diligence, which is a combination of, as you've alluded to, those reports, which is, your building condition report, which does your structural, your roof, and your major components, phase one environmental assessment, and the appraisal. So you need an AACI appraisal. Now, the one step I missed in the offer piece, and this is the other mistake I see people doing all the time, they'll take the pro forma, okay, great, and they'll go make an offer on the property. The offer is accepted. Then they go to their mortgage broker and then they realize, oh, I'm not getting the loan that I think I'm getting. So the critical piece that you need to do before you do an offer, well, really two things, is you need a rent survey of the area because you need to know what the actual rents are. I mean, just because the pro forma says the rents in, Drayton Valley or Red Deer are, 1,200, you don't know that unless you do a survey of the area.
Right.
So you need to survey the area, and you also need to give the numbers to a mortgage broker, and they'll tell you what the loan is, what the maximum of loan to value is. And this is critical because honestly, this is a moving target. A year ago, you could have borrowed like that 20 suite example I was telling you, right? Like you could have borrowed 1.6 million on that deal. Today you might only borrow 1.2 million on that deal because it has to fit into that debt coverage ratio, right? So that means the net income of the property has to have a safe cushion, usually about 20 to 30% over what the mortgage payment is.
Right.
And that's changing almost every day.
Yeah, and
So,
and this is where now you got to be a sophisticated investor as well too, because now
yeah.
you're short, like what you're saying, several $100,000, and now it's either you got to come up with those extra funds, or you got to be able to raise it somehow, right?
Well, or you go back to the seller and ask for a reduction. So, generally what I do, because I don't want to waste the seller's time, I know exactly what the building value is when I make my offer, because I've surveyed the rents and because I have a loan opinion from a broker. Now I'll put my offer in, and more often than not, they end up laughing at me and saying no. And I say, okay, and then the building gets tied up by somebody else, it falls apart. Gets tied up by somebody else, it falls apart. Oh, and then they finally I get the call. And not to gloat, but I mean, I've gotten 3 buildings that way, including the last one I purchased. So doing that extra step at the beginning is well worthwhile. Once you get in there, the first thing you got to do is you got to do a walkthrough. So
Right.
now you want to take your
And before
property
that
manager
walkthrough
through.
course, so let me just step
Yeah.
back a bit, because so you've done it for, you've bought multiple properties and done this for so
Yeah.
many years. You have a very good understanding of the value of that property, where now somebody that comes in afterwards, they don't, or maybe they're a little bit newer, so they're willing to go a little bit higher. But then now when it gets to the bank, because the bank now, they've got to look at it and say, does this deal make sense? They're not looking at you, they're looking at the building. Is that correct?
Yeah, you said it perfectly, Gary. And this is the other reason why I love multifamily, because in single family, it's cowboy capitalism. You pay what you want to pay as long as the bank sees you as an acceptable credit risk, they're going to give you the loan. You could be paying twice as much for the houses that it's worth, right?
Right, right.
With commercial, no, the bank is your partner. And in my opinion, they're also your best friend, because they're actually, they're saying, look, this is all we can lend on. So the numbers are really black and white in multifamily. It's very easy for me to justify the going in value. Now, this is where a lot of newbies get in trouble. They want to do these creative deals, right? I want to do an agreement for sale. I want to do a very large vendor take back loan, which is okay if you know how to underwrite the value of the building a couple of years from now when you have to pay that out, right? But you can easily over leverage yourself if you don't have the bank on your side early, right? So that's critically important.
That's a good
But
point. Yeah, because a
yeah,
lot of people do want to do a lot of that creative financing. And like what you're saying, there's nothing wrong
yeah.
with it. Just know what you're doing when you're being that creative, because you could put yourself in trouble.
And even the most conservative deals today, like honestly, I wanted to do a renewal. I have a large 3-story it's a mixed commercial, townhouses and commercial bays. The thing is worth, well, the appraisal was almost 3.4 million. I could barely get a loan of 60% because the banks were scaling back their loans so much. So if you take on a 90% loan vendor take, the banks may not want to lend you enough money a year from now to pay that out. Or
Right.
even if you just take a 5-year loan, right now, you have to make sure that you have enough equity, because the bank is asking you for your net worth statements, your rent rolls, your op statements every single year, right? And when it comes to the end, I thought I was going to do a simple renewal, right? No. I mean, many investors that I know, they think they're going to renew the mortgage or refinance and pull out a bunch of cash. And instead, that's like, okay, you need to pay down the loan 200,000, 300,000, $500,000.
Right.
And those are the calls they're getting. And then you're in a really tough jam of, going back to your joint venture partners for cash calls. So this is why I very, very, very much try to warn people. Your going in valuation is critical.
Yeah, and I guess especially too after what happened last year with all those rate hikes, you're probably seeing more and more of that, where these investors have bought many of these multifamilies, and they're like, okay, well, how am I going to get out of this situation? And they've done a vendor take back, and it may be only for what, a year or so, and now they want the lender wants their money back, right?
Yeah. Yeah, no, absolutely. Like, at the beginning of 2022, I mean, you could have got a CMHC loan for a multifamily under 2%, right?
Yeah,
Now it's like 4.5%. So, they're using that same debt coverage ratio number to determine your max loan. But now the average loan on a 20 suiter has been scaled back for $500,000 from a year ago.
yeah,
So a lot of people went nuts during the pandemic too when those rates dropped to almost zero. huge refinances on their property, right? Like 85 loan to value. Some people did 95 loan to value under the CMHC Select program, which, okay, I guess that's okay. But what's going to happen 5 years from now? You got to make sure you have enough juice in there to be able to even renew.
Yeah, for
So
sure.
leverage management is critical.
Yeah. Now I did cut you off there. Now you were talking about the walkthrough. So when you go
Oh,
through the
yes. Yeah.
walkthrough, what are some of the things that you're looking for, and what are some critical things that a lot of beginning investors may miss?
Yeah. So the big difference between multi and single family on the pro forma that I talked about, where there's expenses, like you'll have your property management, your property taxes, your gas, because you do pay for all utilities. What is not on the pro forma is deferred maintenance. So if the roof needs to be replaced in 5 years, that ain't on there. The decks, the boiler system, the parking lot, and in my experience, every time I bought a building with deferred maintenance, it's bit me. I think, well, I'm going to buy this and sell it in 5 years. So I'm going to offload this roof problem onto the next buyer. And I always get stuck with it. And even the most sophisticated multifamily investors that I know fall into the same trap. So you really need to deduct those deferred maintenance costs from your purchase price. So that's first and foremost. But the main thing is the walkthrough. So, let's say I agreed. This is what happened, a real live case study. So I went to buy this building in Leduc. It's in Edmonton.
Yep.
And it was 95,000 a door. I thought, great deal. So I walked through it with my property manager. He manages buildings all in the neighborhood, like 4 or 5 buildings in the surrounding, couple blocks. And after I was over, I was all happy. I'm like, this is a steal. And he goes, well, no, because you have to spend about 18,000 a unit to get to the market rent that you want, right? So we have to renovate, 6 or 7 of these 17 units. It's going to cost you like 200 grand. So I did the math, and then we realized I need to get this thing for 85 a door, you know? So then right away we said to the seller, look, we can't do it. And the seller said no, right? So we lost the building, and then it got tied up by somebody else. Then about a month later, they came back and called again and said, okay, yeah, we agree to 85, and we bought it. So that was a critical step because the property manager knows the market. He knows how much money you have to spend on the unit to get that rent.
Right.
A newbie investor might have paid that much, but then you may not even recoup enough equity in your refinance to pay for your renovations. So that's the other common thing I see too. Like if someone buys a building for 100 a door, right, and it needs 10,000 of renos, right, they're going to pay 90. Well, you really should pay 80 because your time is worth something, right? You
Right.
have interim financing costs, but all sellers want last year's prices. They want, and this particular building had a high vacancy too, which helped us out as well.
Right.
But again, completely different dynamics. I'm assuming most of your audience is in Ontario. It's different on the prairies. I mean, we have no rent control, so it's easy to do a rent survey. You can't really do a rent survey in Ottawa or Toronto because you could have 20 suites with 20 different rents because of rent control. There's no really way to survey. So there's different dynamics to multifamily investing depending on what province you're in.
Right. And I guess also too, because being in Ontario and being out in Alberta or Edmonton, it's not easy to evict tenants here, but it sounds like it is out there, correct? Where you can just give them the notice. How does that work? And what are the differences look like?
Yeah, I mean, I've heard the nightmare scenario in Ontario that professional tenant, it'll take you like 11 months to a year to get a hearing if they stop paying rent. Like,
Oh yeah.
I live in British Columbia, and it sounds like it's very much the same there. Non-payment of rent is an automatic eviction. In Alberta and Saskatchewan, you can generally get someone out within 30 days. It's not that difficult for non-payment of rent. Now it's tougher. I had a tenant I had to evict in Saskatchewan. It was a little bit tougher. It took me 6 months. And on the way out, he basically trashed the suite. He cut all the pipes, turned the water on, and walked out. He cost me about $30,000. You get those bad tenants every now and again, and unfortunately, there's little I could do. I inherited this tenant with the building. Alberta, you can raise rents once a year with 90 days notice. So a popular way is to economically evict somebody too, because you can just increase the rent to something they can't afford. I mean, you can do that too, but you risk being on the news, right? If you do
Yeah, yeah.
that,
Well, you
as
can't
you
do that in
know,
Ontario. You can't do that in Ontario. Well, for certain properties, anyways. I won't get into too much detail on that, but yeah, certain properties you can, and a lot of them, most of them, you can't.
Yeah, and in Saskatchewan, it's even easier because you can raise rent every 6 months with 6 months notice.
Wow.
So, for example, we have a very tight vacancy market because of a lot of immigration, a lot of people from Ukraine coming to Canada, and they're going to Saskatchewan. So we have like no vacancy in our buildings. We've increased our rents, 3 times in the last 18 months, and we're giving big increases. But it should be noted that in Saskatchewan and Alberta, our rents today, as of, February 2023, are still lower than they were in 2014, 9 years ago.
Really?
So I'm
And
looking around Kelowna here. We went up 40% in a year. In Ontario, rents have probably doubled or tripled maybe in the same time, right?
right. And why is that? Is that because of, like, I know you guys have boom bust cycles out there, and is it because of the oil fields, and is that what it mostly is because of?
Yes, exactly. I mean, we had a commodity bust in 2015 where, the price of oil in Saskatchewan, it was uranium, fertilizer, just about you name it, all imploded at the same time. And you're right, that oil crash really, really hurt Alberta for a very long time. And I've been on a few of these podcasts, and a lot of people from Ontario are saying, well, man, I would never invest in Alberta. It's like cycles, it's crazy. But me being from there, it doesn't seem risky. This just seems normal. So as
Right.
long as you don't overpay, but I'm only paying 100 a door for buildings where you're paying, 300 plus out east. So it's really relative to what you buy, right? But yes, generally every 10 years there is a cycle in Alberta, a boom and bust. We went through it in the 90s, we went through it in the 80s. Right now we're at the very end of what looks like the end of the 90s, where we're seeing rents rise really fast. 60,000 people moved to Calgary in the summer of 22. Rents there jumped up like 30% in a year. So, we're starting to see that upswing now, but I think there's still a lot of upside. I mean, if you look at across the country, the average 2 bedroom rent or 1 bedroom rent is over $2,000, right? I mean, we're still only at $1,000 in Edmonton. So we
Right.
got a ways to catch up.
So Edmonton seems to be the better market to be in right now out in that area. Would you say?
Yeah, it's just because there's the apartment universe is larger. There's a
Yep.
lot more buildings than Calgary. Calgary is more of a white collar city, Edmonton's blue collar. But even Saskatoon, prices are coming up really fast. I'm finding it more and more difficult to find deals. As hard as I look and as many deals as I have to choose from, it's getting tougher. But I really believe in the next 18 months, there's tremendous upside. I think we're going to see at least a $400 increase in rents in the next 18 months. So, I mean, I think that 1 bedroom rent's going to go up to 16, 1700. Twos will be in the 2200 range. And if you cap that out on a 20 suite or on a 40 suiter, you can make a lot of money quickly. As every dollar of income increases the value by $200 to the building.
Wow.
So if timing is right, if you can find a building that makes sense and you don't have to pay a fortune or fix a bunch of things, and now's the perfect time.
Right. Okay. So let's kind of dive back into it. So you've done your walkthrough, you've done your
Yeah.
environmental, everything looks good. You're ready to rock and roll. The bank says, yeah, you know what, I'm going to loan you the money, Cory. And the property closes. What is typically kind of next now once you do get the keys, and moving forward with that investment property that you have?
Yeah, so great question. I have two strategies. Now I'll use the dreaded BRRRR term. I never used to do BRRRRs, but the last two deals, because we've done short-term financing, we've
Yep.
done bridge loans, which are very expensive. We're under tremendous pressure to get those rents up quickly. So we basically go in there immediately and we raise rents to just about everybody, but we say we don't just do it like arbitrarily. We say first, okay, we're taking over. We'll do the vacant units. We'll do a nice show suite. We'll add dishwashers, make it really nice. Spend about 20,000 a unit, and then we tell everybody else, okay, we're going to do your bathroom. We're going to spend 5,000. Oh, but by the way, your rent is also going up. And then you usually get about half the people leaving. So right now, that's the strategy that I'm employing today, simply because of the short-term financing, right? We're borrowing, pretty high rates. We can't afford to do that for very long. We need to get the value up quickly. I'll be clear though, that's not my preferred strategy. Almost all of my JVs have been very simple. It was non-CMHC financing, conventional loan. I buy a building that's already, stable and functioning, get a 5-year loan, 25% down payment, sit on it for 5 years and just raise rents, only renovate units when they turn over. Very boring, nothing to it.
Right.
So, especially if you're new, that is the strategy that I would highly, highly recommend. The burrs can work, but you got to get them at a very low purchase price, especially today, because the financing costs, you're looking at 11, 12, 13% interest to borrow, right? And then you have to get the rents to a certain point to pay that out. And that's very difficult in 2023 than it was in, last year, the year before. So
Right.
you're going to see less and less of those burrs. You're going to see more creative deals that we talked about earlier. But generally, what you want to do when you get in is you want to just stabilize it. You want to put your brand on it, you know. But again, it depends on how aggressive you wanted to get with renovations. But really, you should set a budget with your property manager, kind of plan to fix what you want to fix. And obviously, going in, you would have a reserve fund. You've done that either yourself or your JV partners. So you know how much you've earmarked for, if you want to do curb appeal, if you wanted to do landscaping or whatever it was. And, the rest is just for vacancy and turnover and unintended expenses that always come when you buy a multifamily building. Always,
Always.
always.
If that's for anything you buy, always. So when you're doing this now, and I guess for me to understand that, what is the vacancy rate out in, it's Edmonton that you're doing these, right? Yeah. What is the vacancy rate there
Yeah,
typically?
it's tremendously different than, in Ontario and BC, it's like practically zero.
Right.
I had a I had a great chat with Elizabeth about this because the buildings in Ontario, a lot of them are old. It's not unusual to have a building that's like, 80 years old. But in Alberta, the vacancy rate, it's actually gone down. The CMHC report just came out a few weeks ago. Edmonton right now, it's about 5%, which is still high. I mean, 5% is really the magic number for a balanced market. That means rents are going up pretty much with inflation, 2 to 3% a year. If you get down to, 2% vacancy, like what we've had in Ontario and BC, you see these relentless year over year rent increases, right? I
Right.
just saw a report yesterday that in Vancouver, rents went up 40, 30, 35% for a 2 bedroom, up to $3,700. Well, that's what happens when you have 1% vacancy.
Right. And these
When,
families
yeah,
have nowhere to go. Right. And that
yeah,
that's the difficult thing out here in Ontario, right? It makes it very hard. Right.
yeah, yeah. And last year in Edmonton, for example, it was 7%. So at 7% vacancy, you can't raise your rent. So as a landlord, you're just barely hanging on.
Right.
But then I survived through 20% vacancy in Saskatoon, barely. But I had to drop my rents like $200, turn over units, fix suites, re-rent them for less, and then have those people leave and rent them for even less.
Oh,
And
wow.
that went on for like 2 years. And I can't believe I survived through that. But having done that now, I'm I'm more confident than ever going forward that I have sufficient reserves. I have experience. I know what to do when this happens. I know you have to lower your rents quickly. You can't be reactionary. You can't wait till your building is empty before you react, which is what I did. So
Right.
there's strategies to survive down markets too that, thankfully in BC and Ontario, most people haven't had to face.
And you know what the thing is too is that you've gone through that, and that also provides confidence in your joint venture partners that you've been through the good times, you've gone through the bad times, and you know how to manage and handle it. And that's what people want, right? Like if I'm going to partner with them, like, hey, look, Cory, you've done this for X amount of years. I know that you've seen different market climates. I'm willing to invest and partner with you.
Yeah, I mean, capital seeks competence. I mean, no question about it. And nothing against newbies, but honestly, if you bought anything in Ontario in the last 3 years, you've done well. I mean, you can't say that you're a genius because that's happened, right?
Right.
I invest with others too who've been through. It's one of my criteria if I'm investing with somebody. I mean, they have to be in it for 10 years. They have to have multiple transactions, and they have to have seen these different cycles, right? It's to be expected because you know you don't know until you get into a deal what's going to happen. But now I certainly know how to prepare for one.
Yeah, for sure. And so what about your thoughts on the market, right? And where you see things going? Because look, you're a new investor, or maybe you got a few properties under your belt. And the question you're like is like, okay, should I invest now? Should I wait? That's like the age old question, and then sometimes people get stuck in this rut of, well, the prices are too high, so I'm not going to get in right now. Okay, well, the interest rates are too high. Well, now I'm not going to get in right now. And it's like, okay, well, when is the right time to get in?
It's crazy, isn't it? Like, a great example of that is this kind of mini boom in January that I heard about. I can't remember which Ontario city it was, but all of a sudden, maybe it was Hamilton. All of a sudden, prices started to go up again because they had tanked like 30%, and now all of a sudden, and rates weren't going up as fast anymore. So it kind of triggered a little buying frenzy.
Right.
But if you really look at the numbers, I'm looking at this. I go back to the RBC Affordability Index, right? I look at pre-pandemic and say, okay, rates were around 2%. I know what the prices were. So now, even though prices have come down, the rates are double or triple what they were. My payment that was 2,000 before the pandemic is still like 4,000 plus. I still can't justify in my head, if anything, the prices is lower than it was, pre-pandemic, looking at what my monthly costs are. But then again, I do understand and can appreciate that there is an incredible housing shortage in this country, right? I'm in the same position right now in Kelowna. I mean, I'm actually renting a place right now, waiting for the right time to dive in and buy a house, right? And I'm asking myself those same questions. It's like, okay, it's dropped now, what's going to happen? But, you see how it goes up and down. Um, but with multifamily, the beautiful thing about that is the dynamics have not changed, right? The value of multifamily didn't go through the roof during COVID, even though interest rates dropped to like, you could get 1.5%. Multifamily didn't go up dramatically. At least it didn't on the prairies, right? I think it did in Ontario. But now multifamily pricing has come down in Ontario and BC, and to some extent also on the prairies. But I think right now there's still a lot of sellers have a really high expectations. I think, January of 2022 is still very much in the spotlight. That's not far enough in the distance because they remember what their neighbor's place sold for, right? They remember
Right.
how much this was worth. They're not going to forget those numbers are now imprinted, and that's what they're measuring it. But I think, as people are getting squeezed and it's homeowners, renters, I mean, this inflationary environment is affecting everybody. Like it doesn't matter who you are, everyone is watching their spending more closely. And housing is going to be no exception. So I know a lot of people are calling for a market bottom, in 2023. I'm not so sure because I think these things take a while to work their way through the system. There's lagging indicators. I'm thinking it's going to be more like the end of 2023, maybe early 2024, maybe even towards the end of 24, because it's also an election year in the US, right? And that, things always kind of go wonky, when that happens.
Right.
And but as far as multis go, Gary, nothing has changed. I'm still underwriting deals the same as I was before. The only thing that's changed is the amount of money they're willing to lend, and the lending criteria, right? I
Right.
used to love conventional deals, conventional financing. They've disappeared. Now CMHC is the only game in town. If you're doing a long-term multifamily deal, you're going to CMHC. Conventional loans are now, I think, 6 or 7% plus. You can still get a CMHC loan for 4.5. So even if you don't want to partner with the government, you kind of don't have a choice anymore.
Right.
But yeah, so that's kind of my stance on it. That was probably a
Yeah,
little bit of
no,
a
and
long-winded
that's
answer, but
no, no, it's good. That's good. And what are you paying attention to? Because it always comes down to, like, I know for me, there's certain people that I listen to, whether it be on YouTube or on podcasts, and I'm like, man, that's okay. That makes sense. Oh, I didn't think about looking at that. Are there anybody that you're listening to, or are there any indicators that you're paying attention to that might be good resources for anybody that's listening to say, okay, I'm going to go listen to this person, or I'm going to go look at these particular charts or resources?
yeah, I listen to a lot of podcasts too. Erwin Zito is a great one. He always has good guests on there, and he doesn't always just hype the market of it's just going to boom. He has a lot of bear guests on there too. So, and he's also looking at the stock market, which is they're kind of related. The indicators that I look at mostly is the 5-year Government of Canada bond, which is determining what the fixed rates are.
Mhm.
And with even multifamily, that's one that you really have to watch. Like it's interesting this morning. I don't know if you were watching, but the stock market is a complete bloodbath, right? Big, huge down day on the TSX. Dow was down like 600 points last time I looked, and the Bank of Canada bond went up. So, usually it's going up when they think, things are good and they want to cool inflation. So, those are the ones I'm watching. I watched the CPI numbers when they come out. Obviously, the interest rate hikes. But I watch the housing market, from across the country, the reports that come out from real estate brokerages, on the sales, the sales listings ratios and things like that. And just the year over year prices and how things change. So, I mean, I'm not crazy analytical, but being a multifamily investor, the biggest ones I'm following are inflation and that bond, because the bond is how much I'm borrowing for mortgages. The inflation isn't necessarily bad for multifamily because it just means more people are going to rent. I mean, if houses are
Right.
more expensive to buy, people are going to rent longer and they're going to pay more. And also they have less money to afford to move, even if you do raise rents.
Yeah,
So that's
and
something else.
that's a good point as well too, because I think what you're alluding to, and correct me if I'm wrong, is that because inflation is going up as much as it has over the last year and a bit, I mean, probably the worst place to keep your money is going to be in the bank. And so you're probably better off putting it into an asset, right? Because one, yes, there's more families who can't get into home ownership, so they need to rent. And number two, it's been proven, over years that you've got somebody paying the mortgage down, you're in a hard asset, and whether you play the variable or the fixed, that's a personal preference. But it seems to be a good hedge against inflation.
Yeah, you nailed it there. And I didn't really know what those words meant so much until recently. I did a podcast recently with Christian Spilfogel. Um, and he said basically that is like inflation is a real problem for people that don't have assets,
Hmm.
right? Because then everything around you is getting more expensive. And if you look at the benefactors of the pandemic, right, it was people that owned housing and people that owned stocks. I mean, both of those went bananas, right? A lot of net worth was created, sorry. But you can see now things are kind of adjusting a little bit. There might be some short-term deficits on those numbers, but in the end of the day, yeah, you want to have these assets, whether it be single family, multifamily, stocks, because as inflation goes up, the debt on those assets, if you borrowed, is also becomes cheaper over time. So, that's kind of why I'm looking at I'm looking at the market in Kelowna, even though, man, do I really want to spend $1 million on a house? But then it's like, well, I might have to. I mean, this is the reality, right?
Yeah, and you know what the crazy thing is about that too. And I mean, I don't know if you've heard my story, but in 2008, when I decided to get into real estate investing, inflation was only 2%. And even at 2%, I did the calculation based on my raise at work the previous year and my income. It worked out to like 1.4, 1.3 something. And I'm like, even at that, I can't outpace inflation by having a job. And the only thing that was saving me was my house. And I was like, well, what if I just have a couple more? This is a great wealth protection vehicle.
Yeah, no, and your timing, like, in 2008, we didn't experience the housing crash that America did during the same time period. So I
Mm.
mean, you probably got in right at the right time. There was a bit of a dip there, but yeah, I was very active at that time too. That was 2008 was also the year that I bought my first apartment building.
Right.
So, you kind of went against the grain a little bit because a lot of people were, panicked in 2008, right? It's like, man, there was no jobs. You couldn't find a job. And here you quit your job to go into real estate, right? Which most people would have been thinking at the time, like, what are you doing, man?
Yeah, and you know what? And during that time, it wasn't only just 2008. I think people forget that it was 2008 up until at least I quit my job in 2014. 6 years,
Oh, okay.
everybody was just like, "Don't quit. Are you crazy?" The market, and every year it's going to crash this year. It's going to crash this year. It was going to eventually crash, and finally in 2017 there was a correction here. But I mean, you sit in the sideline for almost 10 years waiting for something that may happen, and you just don't know when it's going to.
And that's the funny thing about markets. Like, in 2014, I moved from Edmonton, Alberta. In Edmonton, that was right before the oil crash. Housing was hotter than a pistol in Edmonton. The house I sold in Edmonton in 2014 was worth more than it is today, right? 9 years later. Kelowna was dead at the time. I moved to Kelowna for a house that was half the price. Now that house is double the price of the house in Edmonton.
Wow.
So it's just crazy the different parts of the country. If you'd have taken all your money, out of Alberta and put it into BC and then sold it in BC, now people are pouring it right back into Alberta again. It's kind of
Right.
doing the complete inverse. But yeah, I mean, you got to own assets. I mean, I'd pick up some more singles in like Calgary would be a great place. I could buy condos or duplexes in Calgary. It's harder to find multifamily. Um, but yeah, you just buy something and eventually you're gonna do okay unless you severely overpay and you can't afford your payments.
Yeah. When you're, and I should have asked this question a little earlier, but we'll ask it now anyways. When you're buying your properties, are you putting them into corporations, and is every property in its own separate corporation, or are you using the same ones? And also, I guess to add to that, are they three-tiered corporation, like a holding company? And right, how are you doing that? How are you setting it up?
Yeah, I've changed things around a little bit. Like so this year I've started to partner up with another gentleman. We were looking at, because we had a lot of capital we'd raised and not many deals. So we were looking at doing a limited partnership model, an LPGP. But then we've kind of been discouraged from that. The way that I've always done it in the past. So I have a hold co, I just have a numbered company myself, and so does my partner. And the building we bought in Leduc, we bought 50-50. So we just basically created another company. We did a unanimous shareholders agreement between us. But most of the time for the JV deals, including the one we're doing right now, it's pretty simple. It's one corporation. We have two classes of shares. We have the voting shares that Mike and I hold, and then the C shares, which represent the equity. And then we do the split that way. And I like that way a lot better because it's really efficient. There's one USA unanimous shareholders agreement document that everybody signs. It's fairly easy to understand. It's fairly inexpensive. It only costs about $1,000 for the corporation, $1,000 for the USA. And really that's all you need. If you go to a limited partnership you need an offering memorandum or some of these other vehicles, the costs are very high, and then you could be raising capital without a deal to deploy. So then you're kind of under pressure to go, if you raise 10 million bucks, for example, it's like, well, man, now I got to go out and, buy some property with that. With the structure that I use is, I can just sit back and cherry pick deals when they come. I just missed out. I put an offer on a 36 unit, and I didn't get it, but there was another one that I just missed out on. But that would have been another one. I just would have been the same thing. I would have started another corporation, and put it through that entity. And I don't anticipate changing that anytime soon.
Right. Now, I don't know if this is the right question to ask or not, and I might just be oversimplifying it here, but is there a certain amount of cash flow that you're looking at per unit?
Cash flow?
Yeah, cash flow per unit. So you buy like a 30 unit apartment building. Are you looking for like, okay, I need to get at least X amount for each of these doors, or is that just oversimplified and there's another way of?
No, it's not oversimplified, and this is actually a great question, and it's something that actually Elizabeth just taught me that I didn't really look at. And I can be honest, in some of my earlier deals, like the cash flow is pretty skinny on a multi. When you take all things into account, you're buying a building that's 40, 50 years old, there's deferred maintenance, you got a lot of costs. So what Elizabeth told me, what her criteria was, is she said I need to see, I think it was $100 a unit um, per month of cash flow. So basically on 20 units, it's like $2,000. So that's what you need after your income, after you deduct all of your expenses and your mortgage payments. You need 2,000 free and clear in that account. And I said, that's amazing. That's a great formula to use. And then I started looking at all my other buildings. Only one of my buildings actually fits into that criteria. So now I've actually incorporated that filter into there. Now, a lot of that is hard to say because you don't know what your actual expenses are, but you can calculate it and kind of build in a factor of safety. You can say like 6,000, 6,500 per unit per year, and then add your mortgage on there. And then you should be left with $100 a unit spare every month. And that's a great rule to live by, because
Right.
if you need cash flow, whether you're not spending that cash flow, but you certainly need that cash flow to survive to get to a capital event, either a refinance or sale, right?
Yeah, for sure. What challenges do you see investors facing this year?
Yeah, like I mean, for the multifamily space, I mean, the common misconception is there's competition, right? There's too many investors and not enough buildings. Well, I mean, that's true in certain aspects if you're going to one realtor that everybody's going to, but there's over 2 million apartment units in Canada, right? Every single one of them is for sale at the right price. I mean, people approach me on my buildings um, all the time. But the biggest challenge today is the lending environment because it's a moving target. And I say that because even the banks that are involved, like I went to do a refinance, and before there would be like 10 companies that would bid on this.
Hmm.
Like People's Trust was one of the main one of the main multifamily lenders for deals like as low as 500 grand. And now they're basically like, well, we're not doing any deals unless they're over $4 million. It's just like, what? They just turned on a dime, right? So I had all these buildings that I have with People's, and all of a sudden I can't get the mortgages from them anymore. So you really have to be up to speed on the lending game, who's lending and how much and the criteria, because I think that's the biggest challenge.
Right.
Finding properties, there's lots of properties to look for, lots of properties to filter. It's just this uncertainty over the lending environment right now.
Right. Okay. What are you listening to for your mindset? Like, is mindset important to you, or skill sets more important to you? Like, is there a balance that you have, or is there one over the other for preference?
Yeah, mindset's key. Mindset can really can really make or break you, right? That's actually just something I've recently started. I know, at the beginning you were talking about doing yoga, for example, right?
Yeah.
Now, I don't know if are you talking specifically about motivational speakers, like that kind of thing,
Yeah,
or
motivational speakers, or like, listen, when you're investing in real estate, it's challenging. There are times when it's challenging. There's times, like I know for me in the beginning, first few that I did, I wanted to get out. I'm like, okay, now I know what people were warning me of, and so the mindset is what at least for me got me through those challenging times. Is belief in yourself, right?
yeah, absolutely. I mean, I had a lot of doubt. I mean, back in 2017, when I had 20% vacancy and I was just like scratching my head, it's like, what the hell am I doing here? Like I've done 6 JVs, I've raised, $10 million, and why isn't this working? And what I did then for my mindset, the biggest thing is I had a really big ego at the time, right? I wasn't really listening to anybody. I thought, yeah, I know this more than everybody. The biggest thing I changed in 2020 or 2021 is I started to reach out to people that knew more than I did. I reached out to other mentors, to other people, other investors, and basically laid it out there and said, "Oh man, like, what do you think of this? This is what do you think?" And then that's actually how I made it through. There were 3 or 4 key people. I love Tony Robbins. I love listening to his stuff. He's got some great stuff, as does Kiyosaki. I love Joe Dispenza.
Yeah.
These types of things. I love listening to that stuff on YouTube. I think it's critical. I used to listen to those cassettes in the truck when I used to work on the service. I remember listening to Art of the Deal by Donald Trump. Back before everybody hated his guts. He he was a hero back then. He was the art of the deal.
Yeah.
So yeah, I think mindset is something that doesn't get talked about enough. And I think the biggest way that you can reinforce that is through mentorship, or friends or associates, people that you can reach out to that'll, like Elizabeth. Like, since I met Elizabeth, sometimes I'll randomly just call her up and say, what do you think about this? Because in almost all aspects of investing besides multifamily, she's more experienced than I am. So
Right.
she can give me a good answer. And she's in the trenches right now. I mean, a lot of people in Ontario aren't doing so well, in real estate, especially if they bought in the last couple of years. So there's a lot of restructuring going on right now, and she's seeing that firsthand, right?
Yeah, no, she's incredible. She really is. I just went out, had lunch with her not too long ago, and not only is she a good friend, but yeah, she's a great mentor. She's been in the trenches. She's taught this for many years, and I think you hit on something. I think that's really important as well too. Is that sometimes we're our own worst enemy, and a mentor or a coach is the ones that can help you spot your enemy before you do, and usually that enemy is you, right? And listen, I get in my way sometimes as well too, because you're like, well, I'm at this level, I've been doing it for so long, I should know this, or I do know this, which is probably even worse, and you don't. And sometimes these things change over years, and you're like, what I thought I knew has changed, and you need that mentor, that coach, to sometimes help guide you through those times, right?
my girlfriend is good for slapping me when I try to be negative. Like if I say something like I'll miss. I'm like, man, I'm dumb. I should have caught that. And she's like, don't ever say that. Don't ever say that you're dumb. It's just it's like you can get around this. This isn't, or if I say that a doomsday scenario, like, oh man, the stock market's gonna crash tomorrow. She's like, no, whatever you say is gonna come true. You need to say, positive affirmations,
Right.
and things like that. She's given me some really good books to read. And for me, my big thing is Taekwondo, right? It's a very spiritual martial art.
Mhm.
Um, I enjoy being physical. I also enjoy skiing, but something about Taekwondo, like yoga, you really need to get that, me time, that hour a day where you can just, close your eyes and relax and, you know, put things in perspective. I think it's really important.
For sure. And you know what? And you touched on a couple things there that I think are important. Like one is, if you believe you can or you believe you can't, you're right.
Yeah.
Right.
Yeah,
And
that's exactly true.
yeah, and you're right. Like for me, you're doing Taekwondo. I enjoy doing the yoga, but I think what it comes down to is just turning your phone off, and spending some time to work on your body. I mean, you only got one body, and you got to look after it. You got to maintain it. It's so crazy that people will spend hundreds and thousands of dollars on fixing their car, but they chintz out on spending a little bit of money on their body. It's the wildest thing.
Yeah, and the exercise is a chore. I mean, you got to find something that's fun. I mean, if you hate the gym, well, the world is your gym. I mean, go outside. There's a ton of things you can do out there, right?
Yeah, I know. I've had some people say, "Yeah, but you like working out." No, I don't. I don't like it. I like the results, but I don't wake up at 6 in the morning and jump in my car when it's cold out. I'm like, man, I love doing this. I hate it. you know
Yeah, I
but
hear
the
you.
results and the way that I feel after, and the changes that I see my body go through, yes, that I enjoy, because I know what it's doing for me, and it gives me energy. It really does. So
Yeah, exactly. Well said.
yeah. So what is next for you, Cory? What are you working on? Where do you see yourself in the next year or even 5 years?
Well, right now, I was doing a lot of coaching and mentoring. So I have a multifamily program called the Six Pillars of Multifamily. I
Okay.
was pretty busy doing that. I was doing several 8-week sessions where it was pretty intensive coaching. I had a total of 60 students go through the program. And it was incredible. It was an incredible experience. I mean, many of my students went on to buy buildings this year. Now, some of them are actually kind of my main competition. So I'm actually getting back to investing full time. Pretty much my week consists of looking for deals, scouting for deals, putting in offers. Now I'm going to be making trips to, to the prairies. I know there's a conference coming up in Toronto. I'll probably attend that. But I think, I'm setting realistic goals. If I can pick up 100 units by the end of the year, I'll be satisfied with that. It's
Wow.
I don't need to hit home runs. I just need to do solid double plays, keep, following my own advice, moving in the right direction, and giving back. Doing shows like this. I mean, I love these podcasts. It's great because people can, they can get inside our brains. Everything you and I say has to be the truth because everything can be fact checked now, right? So you can't
Yeah,
you can't
exactly.
exaggerate, right? So, I've done about 20 of these now, and it's like, man, I hope I've said the same thing in every one, but you got to tell the truth.
Yeah.
Um,
And
and we're doing the summit because the summit is really very important. We're doing another resilience. It's actually on the anniversary of last year, so it's going to be October 5th, 14th, and 15th. 2 solid days of that resilience. We're going to be talking about preserving wealth, obviously the most important. We're going to be talking about identifying opportunities and taking action. So those are the
awesome.
themes, and we're going to be doing that again this year. So that's going to be wonderful.
Great. Well, listen, Cory, I appreciate your time. I've got your information. If there's any additional URLs that you want me to add to the show notes, I'll definitely add that when we're going to release it. Any last piece of advice, and how can people contact you if they want to learn more about Cory, or even attend and join your 6 pillars of success?
Yeah, so the easiest way is just go to my website. It's altynequities.com, ALTYN equities. I'm not going to spell equities. Yeah, you can find everything on there. There's a link to the 6 pillars. There's just hit the contact and just, drop me a line, send me your number, set up a free Zoom call. You can be happy to set up a call just to chat about whatever, right? My
Awesome.
best advice for people today would be don't get discouraged. There's a lot of bad news out there, but I think I'll double down on what you said and just turn your phone off. There's probably 90% of what you see out there is noise and nonsense. And, when you look at a deal and a real estate deal, you know, look more at the deal than what's going on in the news. There's good deals everywhere. And I think right now is a good time to invest depending on where you're at or what you're looking for. But at least for me, multifamily is the way to go. And I'd say if you have the capability to do multifamily right away, don't delay. I mean, a lot of people, they do it later after they've done singles for many years. Every single multifamily owner that I talk to will say the same thing. I wish I would have started this sooner. Because once you get into that first building, you can scale up and multiply significantly quicker than you can with single family.
Yeah, great advice. It really is, and I appreciate you sharing that. And you're right, man. There is a lot of noise out there, and you turn your phone on and you go on social media, and all of a sudden, it's like it feels sometimes like it's the end of the world. And
It sure does.
you got to protect yourself from that noise. You really do. I'm not saying not to pay attention to it, but just limit it. Just limit it. Those things have always been going on. I think it's a little noisier right now, but you got to find a way to kind of break through that noise and focus on what's important. Because at the end of the day, you're not making any choices or decisions when it comes to Ukraine or printing money, none of that. So you have to work within your environment, okay, and just cut through the noise. That's all you can do.
Absolutely. Well said.
All right, Cory. Listen, I appreciate your time. I really enjoyed this, and I know everybody else that was listening will enjoy it as well too. So thank you, and I'm looking forward to the summit, and I'm looking forward to doing more work with you. And I appreciate you sharing your story.
Yeah, me too, Gary. I'll have to have you on my show next.
All right, I'm looking forward to it, my friend.
All right, you as well.
All right, take care, Cory.
Yeah.
Bye.